Hi, folks. Welcome to SQE1 window. And the journey we are going to start today is in business law and practice. So, to start with chapter 1, we will look into forms of business organizations with context to United Kingdom. So, here or everywhere, every business begins with a simple question: what legal form it will take? This choice is rather like choosing your first car, cheap and cheerful, or reliable and built to last, for example. The decision shapes everything that follows: how much tax you pay, who manages what, and what is the most important thing in business is that who ends up paying the bills when things go wrong. So that's the most important thing you need to look at once you are deciding about business choice. So UD gives us a list of options from the humble sole trader right through the mighty private company. Each has its own charms and its own traps. The trick is to balance control with protection. And for those of you preparing for the SQE1, remember your task is not to memorize labels, but to understand how each structure differs in law, risk, and governance. So all of it you need to keep in mind once you are answering any SQE question. So the first one to start with is simple but risky, that is sole proprietorship. So to start with, imagine you open a small cafe on the corner and put your name on the sign. That is it. You are a sole trader. There is no legal separation between you and the business. The profits are all yours. And so are the debts. No company house registration, no endless forms, just you, your business, and perhaps a rather nervous accountant at some point. The downside? Unlimited personal liability for that business. If your cafe burns, and there is a damage, you owe supplier your personal assets even. Yes, including your beloved car could be used to pay them. Simple, yes. Safe. Not quite safe. Yeah. So the next thing is partnership. Think of it as two or more people joining forces for profit. What could possibly go wrong? Under the Partnership Act 1890, every partner can bind the firm, and by default, they share profits, losses, and management equally. It is democracy at its most dangerous. Like sole trader, partners face unlimited liability. So if one partner makes a catastrophic business decision, everyone pays for it. It is a bit like being in a group project, except this time your house might be on the line. No formal registration is required for partnership, but a written partnership agreement is advisable. People don't write it, but it is advisable. It is cheaper than friendship counseling later on at the point, like you fight for that, like, yeah. So it's not essential to write it, but of course, like, it is advised that you should write your partnership agreement to make things certain. So the next thing is limited liability partnership. It's hybrid model. It's between partnership and company. So they came with Limited Liability Partnership Act 2000, a hybrid design for professionals who like teamwork but not personal ruins, like at the cost of other people at that point. They don't want to give away their own assets, so that's why they limit their liability. So an LLB has its own legal personality and gives members limited liability. Members can share management and profits while protecting their personal assets. It can borrow, sue, and be sued in its own name, and it carries on even if a member leaves, well departs this world. It is still there. It is not dead as simple partnership is. Like when someone leaves, partnership is gone. Of course, this sophistication comes from at a price: registration with company house, annual filing, and usual paperwork that you need to do. It is perfect form for law firms, like it's perfect form of business for solicitors, accountancy practices, and anyone who enjoys the thrill of compliance deadlines and all of it. So the next is private company, limited by shares, secure and separate. So to understand, it is created under the Companies Act 2006. It is a separate legal person owned by shareholders and run by directors. At separation, at the question of separation, it is vital to understand the company, not its owner hold the liabilities. Shareholders' risk is limited to what they have invested or promised to invest. The company can raise money through shares or loans and continue to exist long after its founder retire, resign, or go golfing permanently. So the company will survive in all those cases. But of course, there is a catch: incorporation, annual filing, disclosure obligation, all fun bits that make directors sigh deeply into their coffee. So still, it is the price of protection and credibility. So the next thing we need to look at is ownership, management, and continuity. So let's line them up for comparison. Sole traders own and manage directly. They are the business. Partnerships share both roles unless they agree otherwise. LLBs aren't companies, like both of them divide ownership from management, introducing director or designated members in LLB who steer the ship. They got the control of steering the ship. So as for continuity, sole trader and partnership often end when their owners do, while LLPs and companies can sail on indefinitely. Investors love that stability. That's why they invest in it. It is much easier to buy shares in something that does not expire with its founder. Of course it is. So the next thing we need to understand is the difference in funding and liability across structures. So funding is another crucial point to decide once you are doing your SQE questions. Sole traders rely on personal saving and the goodwill of their bank manager. So if they have goodwill, they can get money, otherwise not. Partnership pool resources, but still expose everyone to risk. LLP and companies, on the other hand, can raise capital by issuing shares or borrowing, a huge advantage when scaling up. Limited liability encourages ambition. And entrepreneurs, like the startup guys, are far bolder when they know a failed idea will not cost them the family home, at least. But their great protection comes from great responsibility. Directors and members must keep proper records, act lawfully, and meet statutory duties with HMRC. And Company House, as you know, it is not famed for its sense of humor, not at all. So at that point, you do have greater responsibility to outsiders in limited liability partnership in Company House. But the cost you pay is, of course, the benefit you get is limited liability, but the cost is disclosure and all of it. So what are we need to understand this one as well. The taxation. Oh my goodness, it's a big thing going on in our country now. Taxation, taxation, and taxation. As it was representation of people, now it is just taxation for the people. Now, the bit everyone loves. Do you think you love it? The taxes? I don't. Sole traders, partners, and LLPs members all pay income tax on their share of profit, whether or not they withdraw them. Companies, however, pay corporation tax on profit, and shareholders then pay income tax on dividends. Yes, that is a double helping. Yes, depending on the figure, the amount that you have earned, it can still be efficient. The companies benefit from lower tax rates and dividend allowance that may reduce the overall bill. That's very meager if you're earning a lot. As for administration, sole traders and partnership are quite quick to start and easy to close. LLBs in companies require incorporation, annual filing, and proper accounting. Fail to comply, and Company House will not hesitate to fine or even strike you off, rather unceremoniously at some point. So the next thing is SQE1 tips and common pitfalls, our favorite slide that we need to keep in mind while we are sitting in our exam. So always begin by identifying the business structure. Ask yourself, does it have separate legal personality? Is liability limited or unlimited? Who controls management and profit? And what legislation governs it? Will give you all answer. And the pitfalls, keep in mind there are some pitfalls that include mixing up partnership liability with that of an LLB. Different. Or forgetting that a company is a separate person in law. Never forget it. That's a separate legal personality who got its own rights and liabilities, can sue and can be sued. Many candidates also overlook the tax and administrative consequences, classical own goal. So when answering SQE1 question, link every point to risk, control, and capital. That's what you need to keep in mind. These are the three pillars of business structure in the United Kingdom. If you can analyze a problem in those terms, you are already halfway to a distinction. Wish you all the best. So from one-man band to the fully incorporated empire, each structure reflects a different balance between independence, risk, and growth. So for your exam and for your real life advices, remember, the best structure is not the one with the least paperwork, but the one that protects you when things go wrong. So at that point, I'll leave it to you to decide. Wish you all the best. Ta-ta for now. See you in chapter 2, where we will explore various type of companies. Bye.